So, you've probably heard all these amazing stories about the stock market, right? People making absolute fortunes. But look, before we get into how to win, we have to talk about a really critical truth, one that honestly most people learn the hard way. And here it is. Before we even get into making money, you have to wrap your head around this simple, kind of brutal fact. Most people who jump into the market without knowing what they're doing, they lose. It's not just a possibility, it's pretty much the default outcome. And I know this isn't just a statistic, I've seen it firsthand. Now, this number, it's not just some random figure I pulled out of a hat. This is a very specific, very personal number. And for my family, it represents a really, really painful lesson. Yup, 10 lakh rupees. That is the exact amount my own father lost from commodity trading in a single night. Because of that one trade, my family didn't just start from zero, we started our financial journey from way back in the negative, buried in debt for years. So, how did this even happen? Well, his story is a perfect example of what goes wrong when you trade without any real knowledge. This was about 15 years ago, and he was trading gold on, believe it or not, an old Nokia phone. He couldn't see any charts or candlestick patterns, just numbers on a screen. And this is the killer, he was using high leverage, which means he was trading with way more money than he actually had. It was great when he won, but it's what catastrophically blew up his losses. Okay, so that story isn't just to scare you. It's actually our roadmap for what not to do. To avoid those same mistakes, we're going to build the solid foundation my father never had. Let's cover the absolute basics that he was missing so you can start from a place of strength, not desperation. Let's start at the very beginning, the stock market. It sounds complicated, but at its core, it's really simple. It's just a marketplace. Seriously, think of it like a giant digital flea market where, instead of trading old chairs and lamps, people are buying and selling tiny pieces of the world's biggest companies. And this is what they're trading. When you buy a stock, you're not just buying some code on a screen or a ticker symbol. You are literally buying a share, a fractional piece of the actual business. You become a part owner. Right, so you might be wondering, where do these shares even come from? Well, imagine a company needs money to expand. Build new factories, hire more people. So it decides to sell off little pieces of itself to the public. That very first sale is called an initial public offering, or an IPO. After that, the shares get listed on an exchange, where you and I and everyone else can buy and sell them. And the exchange? Think of it as the building where all this trading happens. Places like the National Stock Exchange or Bombay Stock Exchange here in India. Their entire job is to be the ultimate matchmaker, to make sure that for every single person who wants to buy a share, there's someone on the other side ready to sell it. Okay, so now you know the basic building blocks. But honestly, that's the easy part. The real dangers are way more subtle, kind of hiding just below the surface. Let's talk about one of the most common traps for new traders, the liquidity trap. So to get this trap, you gotta understand how a trade actually works. It's basically a negotiation. On one side, you've got buyers making offers. The highest price they're willing to pay is called the bid. And on the other side, you have sellers setting their prices. The lowest they're willing to accept is the ask. Now, that little gap between what the buyer wants to pay and what the seller wants to get, that's called the spread. If that gap is super tiny, it means there are tons of people actively trading. We call that high liquidity. But if that gap is huge, well, that's a massive red flag. That means low liquidity. But why should you care about this gap? What's the big deal? Let me tell you a quick, real story that shows you exactly why this is so dangerous. It involves a trader, what looked like a profitable position, and a really nasty surprise. All right, picture this. A trader is looking at his screen and he sees a nice profit. He's happy. He thinks, okay, time to cash out. He hits the sell button, but instead of seeing that profit hit his account, the trade closes at a loss. The money he thought he had, poof, gone. Wait, what? How does that even happen? This is the question that blows everyone's mind. How can a trade that looks profitable on your screen instantly turn into a real loss the second you try to close it? The answer? That hidden liquidity trap. You see, the price he saw on his screen was just the last traded price. It wasn't a real live offer. When he went to sell, there was nobody there willing to buy at that price. The next person in line to buy was offering way less. And that huge gap, that massive spread, just completely swallowed his profit and flipped it into a loss. He got trapped.
Okay, so we've seen the big emotional risks, like my father's story, and these sneaky technical traps, like illiquidity, which brings up a really important question. How do the pros, the experienced investors, avoid all this stuff? Their answer? Well, it's probably not what you're expecting.
People ask me this all the time. You teach this stuff to millions of people, they say. So what's your secret? What stocks are you buying? Show us your portfolio. And here's my answer. And this might be the most surprising thing you hear in this whole explainer. I do not own a single individual stock. Not one. I invest in the stock market for sure, but I don't hold shares of any specific company. So why wouldn't I own individual stocks? Well, first you've got something called concentration risk. I mean, think about it. Would you ever sell your house and put all that money into one single stock? No way, right? The risk is insane. So to get around that, people buy like 10 or 20 different stocks. But now you have a new problem. It's like buying lottery tickets. A few of those are going to be duds, and they can easily drag down your winners. And honestly, on top of all that, who has the time and the mental energy to constantly keep track of that many companies? It's not a side hustle, it's a full-time, super stressful job. So this leaves us with the most important question of all. If picking individual stocks is so risky and so stressful, what's the alternative? The secret is to stop trying to pick the winners. Instead of picking stocks, you buy the entire market. I invest in low-cost index funds, which automatically own a tiny piece of hundreds or even thousands of companies all at once. This gives you maximum diversification, it crushes your risk, and it takes almost zero stressful monitoring. It is by far the most proven path to building wealth confidently and with total peace of mind.